Today I would like to show you how to work out the financial feasibility for a chili pepper farming project. What we need for this is a financial model template from efinancialmodels.com. First, we will have to work through the assumptions, and the idea is to prepare a financial plan with a forecast period of up to 10 years and also work out the budget of the first year. We start with the general assumptions and settings we need to pull up this model. So we start with the currency, the first forecast year, the units, are we talking acres or hectares, pounds or kilograms for the volumes. So we enter all these settings here and we are ready to roll. In our project, we will have different land parcels to work with. So as you can see here, we start with 6 acres in year 0. 2 of them will be owned and 1 will be rented. And then we are going to expand in the next years with additional land rented or land owned. What we also can do is we can change the start years and see what happens if we would start the expansion a bit later on. Then the next area we need to think about is what will be the annual harvest yield. So here we expect about 20 tons on average of chili pepper being produced per acre. Then this will allow us to forecast the volume of the chili pepper to be produced per year. Then the next question is at what price we can sell our produce. So we enter here our assumptions. By the way, these are assumptions. These are all for illustration purposes. You will have to do your own due diligence and investigation to see which numbers do apply in your own local area. We have the price. Then we need to think about inflation. Is this price on average going up? Will it stay stable or might it go down? So the pepper price we assume stable, but the costs, we expect that on average the cost will go up due to inflation every year. Then we need to think through about the initial CAPEX budget. We'll have to spend money to either acquire land in case we don't rent it, then also for other positions including vehicles, machineries, equipments, etc. This will give us the required expense we will have to lay out at the beginning, and will also part of our uses and sources of funds table. Then once we get going, what will be the ongoing costs? So here we separate or we differentiate between direct costs and operating expenses. Direct cost consists of the activities which will go on our farm. So we'll have, in our case, we have 4 activities. One is the planting. What will be the cost per acre for all these types of, for getting the seedlings, the preparation of the land, and also the actual plantings. Then about the growing, we need materials and we need labor. What will be the costs broken down by positions? Then the harvesting and then the processing. This will give us an annual direct cost budget per acre per year. Then we continue and we also estimate the fixed costs. Whatever positions we have to enter. We have to put together a fixed cost budget. What we also have to keep in mind is that our customers might ask for some days to pay their invoices. So the question is, how long do we need to wait until we get the money paid? How much inventory do we need to keep, and what's the time frame we will have to pay our suppliers on average? Once we have that, we'll also need to look through our first year's budget. So what we do here is we will have to put up a schedule. We can overwrite this, whatever month you would start the year, we need to set. And what we need to do is we need to break down the planning assumption for year 1 and say in which months do these revenues in this case occur, in which months do these costs occur. The way we do it here in this model is that we allocate the percentages. So from the annual harvest volume, for instance, we expect the first year is the planting month, then we need 2 months until we can get to the first harvest, and then we assume basically monthly harvests after that until we need a replanting for the next year. However, this is just one example. You will have to check what your realistic harvest schedule will look like, and depending also on the type of pepper you are growing. So once we know when the harvest will be, then we need to also break down the volumes just to check. Here we assume that the yield will be the same throughout the year. This will give us the monthly volumes, and this will also give us the revenue schedule. As said, planting we expect only one time per year, while the growing should occur basically throughout the year, and the harvesting should occur once we start with the harvesting activity, harvesting and processing, and so on and so on. The point of putting a monthly budget together is also to have a look at the cash flows. And as you can see, because we don't have a harvest in the first months, this means 2 months will be cash negative. And this we also mean we need to, if we actually will also need to finance this part. So whatever we spend in the first, to start the project, there will be additional months until we can get the first harvest. So we need a bit of cash buffer here, and we go back to the uses and source of funds table. And as you can see, if I would not put any cash buffer here, we would be short in one of the months. So we add some cash buffer here that we are always liquid and we can pay and meet our obligations. Then the next question is how much debt financing we can obtain. So we'll have a discussion with our bank. Whatever amount we come up with, we have to enter in the model, and then we have to see if that is realistic and will work with our plan. So I think we're pretty much through in configuring the model. Now let's have a look what will be the expected financial plan. And as you can see, we start here with activities in year 1. Basically, first year we already get income. We are profitable basically here as of the first year. And what you can see is that after some years we start to add the additional 2 acres for our land. So our size of the operation will go up slightly and we can get a bit higher volumes. Then what we also want to look through is basically a bit, as you can see here is the ramp-up plan, the land under management, and here we add some lands. So this is how it's going to add up. Then we also will have a look at the profit per acre, and we can see on how much will be the revenues, how much will be the EBITDA, and how much may be the net income per acre we can expect. Because here it's profitable, actually a good idea would be to grow this project further and actually take much more land under management. So what we could do is we could simply also plan to keep growing and every year increase a bit the land areas which we are working with. In this case, let's just assume we're going to rent and purchase additional lands every year a bit more. And then what will happen is that we can start to simulate how this ramp-up plan will look like and what will be the effect on our profits and the profit margins. Then what we also want to do is to look at the debt financing. So as we said, we plan to take on some debt. Then we need to compare this to the EBITDA, to the profits we can occur. And as you can see, if we calculate a debt EBITDA ratio, actually 1 year's profit should be sufficient in this case to repay the debt. So this means this plan actually would have some room to take on even more or ask even more debt from the bank. Then we also can see the other ratios. Maybe important is also payback periods. So we can see whatever we invest here, we can get back within 3 years if we run this plan. We also can check if this changed something. If we look at the levered cash flows, meaning after taking into account the debt financing, while the unlevered is just the project itself without differentiating if it's debt or equity finance. Then we also need to ask ourselves the question, so If you're going to invest this amount, is the funding needed in terms of equity? Let's say we have this money and we will finance this. So what will be our return? And what we do is we look at the levered free cash flows, and we can see here we get here the percentages, the free cash flows which are available to us. And as you can see, we can basically repay the initial investment within a few years, about 3 years. So this project is quite attractive to us, and also the other financial metrics, they look pretty nice. So this means it should be quite interesting to do this. Another question which might come up is how risky is this project? For this, we'll have a look at the break-even analysis. The first question is what selling price do we need to achieve break-even? Our base assumption is $0.80 per pound. As you can see, we would need only $0.61 per pound to achieve break-even. So we have a bit buffer here. If we look at the same question, but we assume the selling price fixed at $0.80, then the question is, let's say our yields there are also a risk that we get less yields than anticipated. So let's say instead of our 120 tons, how much tons we would need to get break even. And as you can see, these are 91 tons. So it's also a bit buffer here. So this will give us an idea how risky this is. And we also need to make ourselves comfortable with our model. So yes, I think that's pretty much how to obtain an understanding of the financial feasibility, how to look at it, what kind of numbers to calculate, what kind of metrics to look at, so that you are ready for a good thought if you want to do this project or not, and also think about how you're going to present this project to your investors or a bank. I hope you found this video useful. If yes, please give it a thumbs up, subscribe to our channel, and visit our website efinancialmodels.com. A link to the template used is included in the description below. Thank you for watching.